Welcome to the deep dive. Today, we're going to be taking a deep dive into Alex Krainer's Trend Following Bible. Now, this book is about way more than just investing, though.
Yeah.
It's about understanding the powerful role trends play in shaping our world,
Hmm.
from markets to global events and maybe even our own lives.
That's right. Krainer argues that we often miss out on huge opportunities because we're so focused on what we think should happen rather than what's actually happening.
It's like we get stuck in analysis paralysis, right?
Yeah.
But if we could just learn to recognize and ride those trends,
hmm
well, Krainer suggests that's where the real magic
He
happens.
uses a great example, the
Yeah.
dot-com bubble.
Hmm.
Even in a market that seemed completely irrational at the time, Krainer was able to ride the upward trend of Amazon
Oh, wow.
and make significant gains.
Yeah.
It's a powerful lesson. Even when everyone else is yelling bubble, recognizing the trend can be the key to success.
Okay, but how do we even begin to make sense of the overwhelming amount of information out there,
Uh,
especially in a field like finance?
well, that's where Krainer gets really interesting. He's incredibly skeptical of a lot of the data and analysis we're bombarded with,
Right.
particularly when it comes to markets.
So he's not saying everyone's lying, but rather,
There are often powerful incentives to shape narratives and maintain confidence, even if it means bending the truth a little.
he gives some pretty wild examples, like the oil price crash of the late 90s.
Oh, yeah.
All the experts missed it.
And think about the way the media often confuses oil reserves and resources.
Hmm.
This seemingly minor difference can have a huge impact on our understanding of global energy markets.
It makes you wonder who benefits from this type of misinformation and
Yeah.
how it affects our decisions. So
Yeah.
how do we learn to filter out the noise and find the real signal?
Krainer argues that we need to be incredibly critical of our data sources,
Hmm.
especially when big money or powerful interests are involved.
Yeah.
Always ask yourself, who benefits from this information being presented this way?
That's such a good point. It's like developing a healthy sense of skepticism about the information we consume. But speaking of experts, Krainer has some interesting thoughts on their role in a world dominated by data. He believes that relying on expert forecasts is largely useless, even in fields like finance.
He uses the example of Wall Street Journal's energy survey from 2019. Practically no one predicted the 2020 oil price crash, and the EIA's 2003 oil forecasts were off by more than double the actual price.
So are you saying all forecasts are useless?
Well,
What about in other fields like weather forecasting or predicting pandemics?
that's a great question. While Krainer is skeptical of economic forecasts, he recognizes that expertise has its place, but only in the right domain.
So how do we know when experts are valuable and when they're not?
Krainer points to a model by Michael Mauboussin that suggests experts excel in moderately complex situations, but their accuracy drops significantly when dealing with highly complex systems like financial markets. It's like trying to predict the exact path of a single leaf in a hurricane.
So in situations like those, relying on experts might not be the best strategy? Exactly. However, Krainer also notes that direct experience can sometimes trump complexity, even in these challenging areas.
He uses some fascinating examples like Christopher Columbus predicting a hurricane based on his observations of the environment, or neonatal nurses intuitively sensing a baby's sepsis before any tests confirm it.
It's all about recognizing the limits of expertise and understanding where direct observation and experience truly hold value. So how does this relate to trend following?
Well, Krainer believes that trend following is all about observing market behavior directly, not relying on abstract models or expert predictions.
It's about recognizing what is happening rather than getting caught up in what should be happening. Which brings us to the fascinating world of quantitative investing, or quant.
This seems like a very data-driven approach to trading, and it's incredibly popular in the finance world, but Krainer raises some serious concerns.
He argues that quant often tries to apply models from physics or math onto a system that's ultimately driven by human psychology.
And as we've seen, human behavior can be incredibly unpredictable. Exactly. He quotes Emmanuel Derman, who points out that models can only describe market behavior. They can't truly explain it. There's a fundamental difference, and it often leads to flawed assumptions in quant.
So even with all this advanced technology, we still can't escape the messy reality of human behavior.
Krainer believes so.
Yeah.
He highlights the risks associated with relying solely on these complex models. For one software, errors are incredibly common and difficult to catch, as examples from MI5 NASA and even rocket launches show.
So even the most sophisticated systems are susceptible to human error.
Precisely. And there's often a disconnect between what quants are good at and what the industry expects of them. They're often forced to be both scientists and programmers, which can lead to oversights and mistakes.
And this raises a question. If quant is so risky, why is the finance industry so obsessed with it?
I think it comes down to the allure of control and automation. We crave the feeling that we can eliminate the unpredictable human element from the equation, that we can find the perfect algorithm that guarantees consistent profits.
It's almost like a desire for a magic bullet in trading.
Yeah.
But Krainer believes this ignores the core reality that markets are driven by people, not algorithms.
And he speaks from experience.
Oh.
He shares a compelling story of his early success trading Amazon during the dot-com boom and then the devastating crash that wiped him out.
It sounds like this experience was a turning point for him, a moment where he realized the limitations of traditional approaches to trading.
Absolutely. He learned firsthand the emotional impact of losses and the powerful urge to get even with the market, which often leads to even greater losses.
So it's not just about the strategy itself. It's
Right.
about understanding our own psychology and how it affects our decision making.
Exactly. Krainer also discovered how difficult market timing can be. Even though he managed to sell some of his Amazon shares near the top, he couldn't figure out when to buy back in.
That must have been incredibly frustrating.
It was a valuable lesson. It highlighted the importance of having a system that helps us manage these emotional impulses and avoid making impulsive decisions based on fear or greed.
It sounds like he's setting the stage for his big argument in favor of trend following, which I'm eager to hear more about.
Me too. But first, Krainer takes us on a detour into the fascinating and sometimes terrifying world of rogue traders.
This is where it gets really interesting. These are the high-flying speculators who made headlines with their huge wins, only to lose it all in spectacular fashion.
Krainer tells the story of Victor Niederhofer, a brilliant trader with a PhD in finance who managed to blow up his fund not once, but twice.
That's incredible. It sounds like he was incredibly skilled and knowledgeable.
He was. And that's what shook Krainer. It wasn't some reckless gambler. It was someone at the top of the game who still fell prey to the psychological traps of trading.
He lists a whole bunch of other famous rogue traders like Nick Leeson, who brought down Barings Bank, Yasuo Hamanaka, and Toshihei Taguchi. These were some of the biggest names in finance managing huge sum of money, and they all ultimately lost it.
It's a powerful lesson. Anyone can fall victim to these psychological biases, no matter how intelligent or experienced they are.
So it's not just about having a good strategy, it's about understanding ourselves and the ways in which our own minds can sabotage our success. This is where Krainer's argument for trend following really starts to take shape.
He believes that this approach, which we'll dive into more deeply in a moment, offers a way to overcome these pitfalls.
It sounds like trend following is less about trying to predict the future and more about recognizing and adapting to the patterns that emerge over time.
Exactly. And Krainer believes this is a much more robust and resilient approach to navigating the uncertainty of financial markets.
Okay, I'm ready to hear more about this trend following approach. What are the key principles and how can we apply them in our own lives even if we're not professional traders?
So we've discussed the pitfalls of relying on forecasts and models, but where do we go from there? Let's explore what Krainer proposes as a solution, trend following.
Okay, I'm all ears. I'm especially curious about how it differs from these other approaches we've been discussing.
Krainer argues that trend following addresses many of the pitfalls we've discussed. Instead of trying to predict the market or perfectly time your entries, you're essentially riding the waves of already established trends. Think of it like surfing. You're not trying to control the ocean, you're learning to ride its momentum.
That's a great analogy, but wouldn't that mean accepting losses as part of the game?
Exactly. One of the key benefits of trend following is that it takes some of the emotion out of trading. Yeah. You accept that losses are going to happen, and the strategy is designed to handle them.
So instead of getting shaken by every dip, you're looking at the bigger picture, the overall direction of the trend.
Right. Krainer provides examples like the gold price explosion in the 70s, which completely defied decades of a fixed price.
Yeah.
Or the long-term trend of declining interest rates. These trends have had short-term fluctuations, of course, but the overall direction has been consistent for decades.
And then there's Bitcoin, which has seen massive gains alongside incredible volatility. If you're focused on short-term dips, you're going to miss out on the overall upward momentum.
It's about discerning the signal from the noise, and that's where understanding trends comes in. This begs the question, where are you seeing trends play out in your own world? What opportunities are others missing because they're too focused on the day-to-day fluctuations?
That's a great question for our listener to ponder. It really emphasizes how these principles can apply to so many areas of life, not just investing.
Absolutely. Now, going back to Krainer's core argument, he emphasizes that price itself is information. It reflects the collective psychology of all the participants in the market.
So it's not just about the fundamentals of a company or asset.
He uses a fascinating example from James Surowiecki's book, The Wisdom of Crowds, the story about guessing an ox's weight. Individually, most people were way off, but the average guess of the entire crowd was incredibly accurate.
That raises an interesting question. How can a crowd be so wise when individuals are often wrong?
It highlights how markets can be surprisingly efficient at processing information, even if that information is scattered among a huge number of people. This links beautifully with the field of behavioral finance, which looks at how psychological factors influence market behavior. Things like herding instincts, momentum trading, and even the fear of missing out all contribute to creating and sustaining these trends.
This reminds me of the striking chart Krainer uses to illustrate the power of momentum. Tesla's market cap soaring past those of established car makers.
It perfectly illustrates momentum investing, buying what's going up, regardless of traditional valuation metrics.
It almost seems like a self-fulfilling prophecy. As more people buy into a trend, the price goes up, which attracts even more buyers. But is this sustainable in the long run?
It's a fascinating feedback loop, for sure. And while it might look like a bubble forming, Krainer argues that these trends can often persist much longer than anyone expects. He even uses the example of Benjamin Graham, considered the father of value investing, who held on to what he believed to be an overpriced stake in Gecko.
And how did that turn out?
It ended up being one of his most profitable investments. It shows that even the most disciplined value investors can benefit from recognizing and understanding the power of momentum.
It seems counterintuitive, but it's another example of how following trends can lead to unexpected gains. Now, Krainer doesn't just talk about the psychology driving these trends. He also links them to something much larger, the role of money itself.
Specifically, the actions of central banks. He cites a book called Dying of Money by Jens O. Parson, which argues that every Federal Reserve easing cycle has historically led to a stock market boom.
That's a bold claim. Does he back it up?
Parson provides data showing a strong correlation between the Dow Jones Industrial Average and the M2 money supply. It's hard to ignore the connection between central bank policies and market trends.
Okay, but how does this actually work? I'm sure many of our listeners aren't familiar with the intricacies of monetary policy.
Well, think of it this way. When central banks inject money into the economy through measures like quantitative easing, it's like flooding a system with cheap credit.
So this influx of money artificially inflates asset prices and creates bubbles.
Exactly. And the problem is, central banks are often trapped in this cycle of intervention. They can't easily unwind these policies without risking a market crash.
So what's the takeaway for our listeners?
Understanding how monetary policy works can give you a real edge in spotting large-scale trends and positioning yourself accordingly.
It's like having a glimpse behind the curtain of how these large economic forces are shaping the markets. But let's get back to Krainer. He doesn't just theorize about trend following. He's actually built a system for it.
He calls it the I system.
So he walks the walk, so to speak. And he even shares the story of hiring Boris Breck, a programmer, to help build the system.
This sounds like it's getting technical.
It does, but what's really interesting is Krainer's emphasis on the principles of systems engineering. He's very clear that it's not just about writing code. It's about a methodical process of defining requirements, designing the architecture, and rigorously testing the system. So it's about taking a structured and disciplined approach rather than just throwing something together and hoping for the best.
Precisely. And he also stresses the importance of thorough documentation. This ensures clarity and maintainability, allowing the system to be used and adapted over the long term.
This is a principle that applies to so many fields. Whether you're building a trading system, a bridge, or even a complex software application, good engineering is often invisible, but it's absolutely vital.
Now, Krainer gets into some nitty-gritty details about designing a system for real-world trading, and some of them are surprisingly important.
Like what?
He talks about the issue of expiring futures contracts and how using continuation charts can be misleading because they don't account for the rollover process.
Wait, can you explain what that means?
Imagine looking at a chart that shows the price of oil over the past year. You might see a clear upward trend. But what if that chart doesn't account for the fact that oil futures contracts expire every month? When you roll over from one contract to the next, there can be price gaps and discrepancies that distort the true trend.
So you might think you're seeing a clear trend, but it's actually skewed by this technical detail.
Exactly. Krainer's I system has a specific way of handling these rollovers to ensure accuracy in backtesting and avoid what's called slippage in live trading.
And what is slippage?
It's basically the difference between the price you expect to get when you place a trade and the price you actually get when the trade is executed. This can happen due to rapid price movements or a lack of liquidity in the market.
Ah, so even small discrepancies can have a real impact on your profits and losses.
That's right. It's another example of how these seemingly minor details can have a significant impact when you're dealing with real money in the markets.
It's like the saying, the devil is in the details. Okay, so we've talked about the mechanics of building a system, but what about actually formulating trading strategies?
Well, Krainer stresses the importance of picking the right price events to trade. He believes in focusing on long-term trends rather than getting caught up in the short-term noise of the market.
So it's about identifying those long-term waves we talked about earlier. What kind of tools does he use to do this?
He talks about simple but effective indicators like moving averages, which help to smooth out price data and reveal the underlying trend direction.
I've heard of those, but could you
Yeah.
explain how they work?
Imagine plotting the average price of a stock over the past 50 days. Then you plot the average price over the past 200 days. If the 50-day average crosses above the 200-day average, it's often seen as a bullish signal suggesting that the trend is turning upward.
Ah, so it's a way to visualize the momentum shifting in a particular direction.
Exactly. Krainer also discusses the importance of identifying local extremes, which are essentially the swing highs and lows in a price chart.
So these are the points where the trend temporarily reverses before resuming its overall direction.
Precisely.
Hmm.
And then there are trend lines, which you can think of as drawing lines on a chart to connect those swing highs and lows. Krainer advocates for tools like speed lines and Andrew's pitchfork, which can help to visualize and anticipate future price movements.
It sounds like a lot of this is about learning to see the patterns and rhythms of the market, kind of like a musician reading sheet music.
That's a great analogy. All of these tools are about filtering out the noise and focusing on the bigger picture. They help to identify the underlying trend and make more informed trading decisions. But Krainer emphasizes that technical tools are only part of the equation.
So what's the other part?
Developing the right mindset. He reminds us that trend following is about more than just crunching numbers.
There's a psychological aspect to it as well.
Absolutely. He talks about the limitations of backtesting, which is a way of simulating how a trading strategy would have performed in the past. While it's a valuable tool, it can't fully replicate the emotional pressure of real-time trading.
Right, because in the real world, you're dealing with real money, and that can definitely affect your decision making.
It's exactly. Krainer shows a chart of a trend-following strategy that clearly performs well over the long term, but it also experiences significant dips along the way. He poses a challenging question to the reader. Would you have the confidence to hold on to this strategy through those tough periods?
It's a gut check for sure. I can imagine those dips would be nerve-wracking.
It highlights the importance of understanding your own risk tolerance. How much drawdown can you handle before you lose faith in your system?
It seems like there's a constant tension between sticking to the system and letting your emotions get the best of you.
There is. And that's why Krainer emphasizes the importance of developing a disciplined and systematic approach to both trading and risk management.
So it's not about eliminating emotions altogether, but about learning to manage them effectively.
Exactly. And speaking of risk management, Krainer has a fascinating perspective on diversification. He draws parallels between markets and natural ecosystems, arguing that we can learn a lot about managing risk from observing nature.
That's an intriguing idea. How does that translate to investing?
He uses the example of spiders building webs. They don't know exactly when or where they'll catch their next meal, but the strategy works over time because it's designed to handle periods of both feast and famine.
So it's about creating a system that can adapt to changing conditions and weather the inevitable storms.
Precisely, Krainer points out how nature fragments risk, meaning there's no single entity dominating the entire system. Instead, you have a multitude of smaller agents, each playing their part.
Kind of like a decentralized network.
Exactly. And then there's diversification across species. They spread out, adapt to different environments, and don't put all their eggs in one basket.
This reminds me of the saying, don't put all your eggs in one basket. It's classic advice for a reason.
It is. And Krainer reflects this in his own investment portfolio design. He advocates for a diversified approach with multiple strategies across a variety of markets. This helps to mitigate risk and increase the odds of capturing profits from whatever trends are emerging.
It's like building a resilient ecosystem, one that can thrive in a variety of conditions. But how do you actually put this into practice? I mean, how do you determine how much to invest in each market and how to manage risk across a diversified portfolio?
Well, that's where Krainer gets into some of the more technical aspects of portfolio design. It can get a bit complex, but the underlying principles are actually pretty straightforward.
Okay, I'm ready for a challenge.
He discusses the challenge of sizing bets across different markets, particularly those with varying levels of volatility.
So some markets are much more prone to big swings than others.
Exactly. For example, the price of oil can fluctuate wildly, while the price of gold tends to be more stable.
So how do you account for that when you're building a diversified portfolio?
That's where a concept called value at risk or VAR comes in. Think of it like setting a speed limit for your portfolio.
Okay, that's a helpful analogy.
Mm.
So VAR is a way to measure how much you're willing to potentially lose.
Exactly. It helps you to quantify the potential downside risk of your investments and ensure that you're not taking on more risk than you're comfortable with.
So it's a way to balance the potential for profit with the need to protect your capital.
Precisely. Krainer provides a table showing various portfolio risk metrics, including VR, the worst-case loss scenarios, and historical drawdowns. This gives you a clear picture of the potential risks and rewards associated with a particular portfolio.
So it's about knowing your risk profile and being honest with yourself about how much volatility you can stomach.
And that brings us to another crucial point that Krainer makes: the need to adapt to change. Markets are dynamic systems constantly evolving, and static strategies are bound to fail eventually.
So you can't just set it and forget it.
He gives a compelling example of how the I-System's performance in sugar futures evolved over time. Newer strategies, specifically designed to adapt to the changing volatility of the market, ended up significantly outperforming the older strategies.
So even a well-designed system needs to be constantly monitored and adjusted based on the changing market conditions.
He shows a chart of the changing volatility in the sugar market, illustrating how what worked in the past might not work in the future.
This brings up a really important point for all of us, not just traders. How are you adapting to change in your own field? Are the tools and strategies that worked for you in the past still relevant in the face of new challenges and opportunities?
That's a question we should all be asking ourselves, especially in a world that's changing at an ever-increasing pace. Despite the recent dip in popularity for trend following, Krainer remains incredibly bullish on its potential.
That's interesting. Why is that? I mean, haven't we just discussed how markets are constantly changing, especially with the influence of things like central bank intervention?
That's true. But Krainer argues that while those interventions might distort the markets in the short term, human psychology remains a constant. And trend following at its core is about exploiting that constant, not predicting specific events or economic outcomes.
So it's about understanding those deep-seated patterns of human behavior that drive market trends regardless of the external forces at play.
Exactly. It's a contrarian view for sure. But maybe that's where the real opportunity lies. After all, if everyone's chasing the same strategy, the profits tend to disappear.
It's like the old saying, the best time to plant a tree was 20 years ago. The second best time is today. Maybe trend following is that tree that everyone overlooked.
Perhaps. Now, Krainer also issues a warning, which I think is particularly relevant in today's world of instant gratification. Be wary of the allure of easy money.
It's so tempting to fall for those get-rich-quick schemes and promises of overnight success.
He cites data showing that a high percentage of traders across various brokers consistently lose money.
So the odds are stacked against you if you're looking for a quick win.
Exactly. And that's where he believes trend following differs. It's not about beating the market, but about understanding and riding the waves that are already there. It requires a different mindset.
More about patience and discipline than finding some secret formula or magic indicator.
Absolutely. He actually provides a list of 12 do's and don'ts for successful trading, which I think beautifully distills his wisdom and experience.
What are some of the key takeaways from that list?
One of the most important is to be realistic about your performance expectations. Don't chase unrealistic returns or fall for the hype surrounding those legendary investors who claim to generate astronomical profits.
Right. It's easy to get caught up in those stories of exceptional success, but they're often outliers or even outright fabrications.
Krainer specifically warns against comparing yourself to the famous Medallion Fund managed by Jim Simon's Renaissance Technologies, which supposedly achieved annual returns of over 66% before fees.
Those are some incredible numbers, but
Krainer is skeptical of the validity of those self-reported figures and cautions against believing that such extraordinary returns are sustainable or even achievable for most investors.
so it's about setting realistic goals and understanding the limits of what's possible.
Exactly. He emphasizes that even the best professional investors rarely achieve returns beyond the high teens, and for most individuals, aiming for consistent long-term growth is a much more realistic and achievable goal.
It's about playing the long game, not trying to hit a home run every time you step up to the plate.
Another crucial point Krainer makes is to never chase losses. It's a common trap that can lead to even bigger losses, a downward spiral fueled by emotion.
It's like trying to dig yourself out of a hole by digging deeper.
He advises against averaging down on losing positions, which means buying more of an asset as the price falls in an attempt to lower your average cost. Often the best course of action is simply to cut your losses and move on.
It's about recognizing when you're wrong and having the discipline to exit a trade, even if it hurts your ego.
And that circles back to the importance of diversification, not just across different markets, but also across different trading strategies. He even shares the performance of his own portfolio over a specific period, which includes a mix of wins and losses across various markets.
So even he doesn't win every time.
Of course not. He's human, just like the rest of us. But his portfolio demonstrates how diversification can help smooth out those returns and mitigate risk.
It's like having a safety net for your investments.
He also advises against becoming emotionally attached to any particular trade or market. Let the system do its work, and don't try to outsmart the market with gut feelings or hunches.
So resist the temptation to tinker or second-guess the system, especially when emotions are running high.
Exactly. Trust the process. He also cautions against getting too fixated on getting the absolute best price execution on every trade.
I can imagine that can become an obsession for some traders.
It's more important to be consistent in your execution and stick to your trading plan.
Don't get lost in the minutia of saving a few pennies here and there.
That's right. And that brings us to another crucial point. Trust your system. Once you've developed a sound strategy and tested it thoroughly, have the confidence to follow it, even when things get a little bumpy. He uses the example of selling his Amazon shares too early. Had he held on, he would have made far greater profits.
It's a classic example of how fear and greed can lead us to make irrational decisions even when we have a winning strategy in place.
He also cautions against becoming overconfident, especially after a string of wins. It's easy to get caught up in the excitement and start taking bigger risks or deviating from your plan, but that's often when mistakes happen.
It's like the old adage, pride comes before the fall.
Exactly. He emphasizes sticking to your risk management rules and not letting your ego lead you astray. And this brings us to perhaps the most important point of all. View trading as a long-term game, not a get-rich-quick scheme.
So it's a marathon, not a sprint.
Exactly. Don't get discouraged by short-term fluctuations. If your system has a positive expectancy over time, the profits will come. This requires patience, discipline, and a willingness to ride out those inevitable drawdowns.
It's not for everyone, but it can be a rewarding approach for those who have the right temperament and commitment.
He also emphasizes the importance of continual learning and adaptation. Markets are constantly changing, so you need to be willing to adjust your strategies as needed. He encourages backtesting new ideas, experimenting with different approaches, and always being on the lookout for ways to improve your system.
So it's about staying curious, staying flexible, and never stopping the learning process.
Precisely. And above all, he says keep the faith. Trend following is a proven approach that's worked for decades, and it's likely to continue working as long as markets are driven by human psychology. It may not be the flashiest or most exciting strategy, but it's one that can generate consistent profits over the long term.
This has been a fantastic deep dive into Krainer's trend-following Bible. We've covered so much ground, from the dangers of market forecasting and the power of momentum investing to the importance of risk management and the psychological challenges of trading.
We've explored the wisdom we can gain from observing nature, the importance of building robust systems, and the need to constantly adapt and evolve our approaches in a world that's in constant flux.
We've even touched on the philosophical implications of speculation and the inevitability of uncertainty in our lives.
This was just a glimpse into the wealth of knowledge and insight that Krainer offers in his book. We highly encourage you to explore it further and delve deeper into the concepts we've discussed today.
So what stood out to you the most? What are you going to explore further based on what we've covered?
We'd love to hear your thoughts and questions. Thanks for joining us on this deep dive.
Until next time, keep exploring, keep learning, and keep diving deep.